Minutes to market open. Taher Badshah is our market master, chief investment officer at Invesco Mutual Fund. Taher, good to have you with us here. Good morning, appreciate it. One of the first big market to come back to 1st April levels, which is the so-called reciprocal tariff levels. So it just tells you, right, the market wants to go higher, lacking triggers maybe for now. What's your sense?
Yeah, I think it's nice to have seen a recovery, and it was from obviously somewhat very beaten down levels, but then we've covered some distance as well. So it's hard to probably call a very strong market direction at this stage, one way or the other. I think we probably just float around at these levels. In my view, I think some of the issues will probably take a little bit of while to pan out. Though I would like to still believe that the bulk of the damage on the first round of headline tariffs at least is behind us. We obviously now move to the negotiation table, and we'll see how it goes with different nations. But to me, it looks like the first round of the trade conflict or the trade war has probably been against the US in various ways, and evident from the fact that they've had to backpedal in many of the areas. So I think we'll have to see as to how it goes. Do they back down a little more, or is it going to be a more aggressive posturing going forward from here, from their side? Meanwhile, I think this 90-day deadline also is not something which is very feasible. But I would still, from their point of view, I think they will want to push it as early as possible so that they can get going with regard to the benefits that they want to derive. So point being that, look, I think we are at a stage where we have to bank as of now on our domestic levers.
Absolutely, and that is what we will focus on, Taher. Sorry, apologies, just interrupting. Markets opening 91 on the Nifty IT index. Taher Badshah is with us. Taher, I interrupted you there. You were talking about, of course, the global uncertainty and the wait and watch, but the local drivers here. I mean, rates is one, right, on the downside?
Yeah, I think rates obviously will be headed lower. Earlier, the expectations were for probably about 50 to 75. We are probably now looking at more like 75 to 100 over the course of the next 9 months or so. So I think that part is quite certain. We have some of the other drivers as well, in the sense that, liquidity is up, regulations are somewhat loosening, government policy and actions are probably a little more vibrant compared to what they were in the prior 2 quarters. So I think there is obviously the one straw that we can probably hold on to at this stage is the fact that we can probably see improved domestic growth. However, upcoming quarterly results, etc., will probably not reflect that. It will therefore require a certain amount of patience from investors to see some of these, actions which have been taken to translate into growth over the next couple of quarters or so. So I think that's basically the name of the game at this stage.
Taher, hi, great to have you on the show this morning. So the question is what you said, that the market might not skyrocket from here, but it will continue to bounce around. Earlier, every time there was a dip, there was a template. You just have to go by and back the same leaders, the same PSUs, the same capex stocks, the same EMS companies. Has that template broken, or has it been challenged? And what are you doing with the earlier leaders, the old favorites now?
So I think at least some of those that you called out are still relatively more domestic oriented, and probably even from a tariff perspective on the right side of things. So I would like to believe that they will still remain the go-to kind of areas. And even for us, I mean, beyond a particular point, if we have to identify places in the market which can grow ahead of system rate of growth, I think only some of these, whether it be industrial, some parts of consumer discretionary, parts of real estate, etc., are the ones which we can probably go to at this stage. So I think that continues even at our end. There have been a couple of other parts which have joined the fray, I would say, in some manner. Let's say value consumption at one level seems to be making some sort of a comeback, and rightfully so, after a long cyclical downturn. And I think we have seen some initial reports on the monsoon, etc., which probably are also promising. So let's see how that pans out. These are all things which are up to see as to what how they turn out to be. But I think these are the areas where probably there is some value. I think pharma too is another area. Combination of some domestic pharma as well as some of those which are probably going to be somewhat better placed, even with a tariff scenario coming into play. So pharma healthcare is another area where we can probably, bank on somewhat better earnings outcomes compared to a few of the other pockets of the market.
Okay, all right, that gives us some ideas. By the way, just want to draw attention to the market once again, because now things have taken a bit of a deeper knock. It's a 120-point fall now on the Nifty. And the problem for the market is that barring one or two of your large cap financials, banks or non-banks, nothing else really seems to be working today. There's a little bit of pharma, but then the tech fall is really deep. Wipro's down now 6%. It's taken the whole sector down with it. FMCG is not working, and even stocks like L&T, Reliance, the other big boys, not able to help the bulls case, at least not right now.
Well, that's right. There's only so much that the Nifty bank can do. The Nifty IT index is under the weather. The Nasdaq was under pressure overnight. You had those numbers from Wipro. And there is a bleak expectation coming in for Infosys. So all those three factors, they are weighing on the IT index, though the Nifty bank is still holding with some mild green out there. And if we need to fight back today, the Nifty bank will need to lead the way. Taher, good morning. Good to see you in. What's your take on these IT names? One argument is that, in fact, valuation-wise, they're pretty okay. They've come to the long-term averages. The problem is there's so much of uncertainty. Guidance cuts, weak numbers, and, you don't know what Mr. Trump is going to do next. What's your approach to these names?
I couldn't agree more, Nigel. And, I have also been kind of latching on to this view that tech will probably be, to some extent, a reasonably good defensive and probably, help us ride a little bit of the domestic volatility. But of course, after these developments, this is the most headwinded sector that we can probably think of at this stage. Both in areas of growth, obviously, we are probably going to, find it difficult from everything from whether it is tariffs, slowdown in the US, what happens to DOGE, and consumer spending and consumer discretionary as far as the US is concerned. So I think there is a fair bit of challenges which are around. And I think at this stage, the only argument that probably is can be made to work for the IT companies is their valuations, and not necessarily as much in terms of price to earnings multiples, but probably if you look at them from a free cash flow yield or an earnings yield perspective, or an cash flow yield perspective. So I think that is the only thing that you can probably latch on to at this stage. But then that clearly means that these now have turned into, they can only be seen as from the lens of value, and then you have to be a patient investor in order to probably get your returns over a period of time. So this, to my mind, is a sector where today, in my mind, is also a debate of whether we should even be a neutral, we should even be holding a neutral weight as far as the sector is concerned. But that's where we are.
The cash flow yield, you said, Taher, was what, around 5-6%?
I'm sorry, what is that?
What is the cash flow yield for these companies right now?
So we are at the lower end of the band, more in the vicinity of 4.5, which is not bad. But that is the only hook that you can probably, as of now, latch on to. But obviously, both news flow wise, numbers wise, we're seeing that in some of the results which have come by, it's not going to be an easy ride. And it all, then we also have the obvious overhang of what happens to AI, at least in the short run, if not in the long run.
Okay, so that's IT, and it's clearly under the weather, like Nigel said. Pharma, something that you said perhaps offers a little more opportunity. Just expand on that point, Taher, because a lot of these companies also have significant US exposure. We don't know if they'll be off the hook or not. There's still some uncertainty there.
Yeah, so at least some parts of the pharma system, pharma sector, which probably is not necessarily only generic based, even if it is exposed to the US, is probably going to be able to weather it better. So upcoming spaces for mid-sized companies, CDMO, CRDMO, that is the part which probably will hold up a lot better, because that is something which at least where there are companies which are relatively better positioned and probably can, are in a position to demonstrate growth which is in the vicinities of the 20s over the next 2-3 years. So I think that space holds, to my mind, a relatively better, attractiveness. And I think then we can always, we also have the option of supplementing that with some of the domestic pharma stories, plus some of the healthcare options also that we have. So that at least makes us a good combined, parcel, which probably can occupy some decent overweight in the portfolios.
Taher, just one point as we are winding up. This point on earnings and narratives shift with stock prices. I've always seen that in my stock market reporting career. When we started the year and Q1, Q2 were bad, we said, oh, it's because of elections and government is not spending. Second half is going to be very strong. It'll be a big recovery. Then we came to Q3. Q3 was a complete washout, 5%, 6% earnings growth. Now we're at Q4. Do you see more downgrades ahead? What is your assessment, expectation from Q4? And more importantly, as we step into the new year, what lies ahead in terms of corporate earnings growth?
So if I were to go back, my memory serves me right. I think we saw the worst, from a market standpoint and from a shock and awe perspective was more like the September quarter, the second quarter of this fiscal, which was clearly subpar, significantly subpar and well below, early single digits. And that's something which probably was the biggest shocker. But I think after that, the expectations then have obviously moved down. There have been earnings cuts along the way. And now I think the market expectations are relatively more, I would like to think at least for the near term over the next 1 or 2 quarters, relatively more subdued. Having said that, I don't think the March quarter results also will probably be able to significantly surprise. I only am hopeful that the pace of earnings downgrades from here on probably will abate compared to the last 2-3 quarters. We are somewhat away from an upturn in that cycle, in the sense that we'll probably take some time before we get into an upgrade cycle. But I think the market will take comfort if there are no further downgrades, and that is what probably March quarter seems to be looking like. Look, like as I said, we are even while some of those domestic drivers are clearly starting to shape up, but by the time they reflect into numbers, will be a few quarters from now.
It'll be a few quarters from now, but maybe